What's going on, guys? Brian's here. Today is Friday, August 19th, 2022, and the market is closed. I hope everyone is having a great trading month. This video is a direct continuation to the video in which I recorded at the start of the month on August 1st, and then I released it earlier this month. It was mostly focused on the gamma exposure for the SPY, so we will be jumping into that in a few minutes, but let's just take a look at the chart. When that video was released, we were looking at right about here. So here's August 1st, and I was talking about the gamma exposure levels at 420 as well as 430, and then we had 410. If you don't know the video in which I'm talking about, it would be this one right here, the SPY gamma exposure GEX market analysis for August 2022, released on August 1st on the YouTube channel. The link to this video will be in the description down below, but we will be talking about how the gamma profile, as I'm going to start calling it, ended up playing out. Now, more importantly, if you guys take note of this right here, this was the highest call open interest when this report was generated. It was including all of the August expirations, and we can see that the 420 strike price was the one that was sticking out, and we talked about how the support level, the strong support level, was 410. We also mentioned 430 was growing, but more importantly, if the market was over 420, I did not think there was going to be enough interest to hold the market past 420. If we take a look at the chart, and let's actually just draw 420 on our chart right here, so let's plot that, and let's just set it to exactly 420, and boom, we have it right there. So I mentioned that the market didn't necessarily have to stay down here. I did end up getting myself in a little bit of trouble at a spread that I opened up a little bit earlier, as I did think we were going to pull back to 400 at that point. Even though I was aware that the market had strong reasons to rally all the way up to 430, I almost could not believe it. Once we got past 420, I ended up thinking that this was going to be the day in which the buying would stall out, and then we'd probably pull back and fill this gap back down to 410. But I ended up being wrong there, as the market did sustain its rally. However, the more important thing to take note of is the monthly OPEX. So today was the monthly expiration. So if you don't know what OPEX stands for, OPEX just means options expiration, and the monthly expirations tend to be very significant. More importantly are the quarterly ones, but the next quarterly expiration is in September right here, and we tend to get a lot of trend reversals around those timeframes. If I were to just turn this on to show you guys for an example right here, so back in the March of 2020 lows, this was the quarterly OPEX, and then you guys can see what ended up happening. We end up getting a massive rally. Now, in between then, we've had trend changes that happen right around these OPEXs. So sometimes they're more significant than others, as you guys can see right here. And I believe I mentioned this in the previous video as I showed you guys this. So while this expiration was not a quarterly OPEX, it was a monthly OPEX. So it was still of some sort of significance. Continuing right along, I want to pick up right where that video left off again, where I mentioned that if the market was to be over 420, I did not think there was going to be enough to hold it over 420. So momentum will carry stock prices way past where they're intended to go, where they're expected to go. That's in a sense the essence of momentum. If there's a lot of momentum, you know, carrying whatever ticker, it can be GameStop, it can be AMC, it can be any of the meme stocks, or even some of the mega cap stocks. It happens with tickers such as Tesla. If Tesla's expected range is maybe 50 points up or down for a particular week, it doesn't mean Tesla won't run 150 points. That was not intended, or was not expected, as it was momentum that carried it in that direction. Now, that can happen in the market also. We had a massive OPEX that happened back here. This was the quarterly OPEX, and then we had another OPEX that happened right around here that also fueled this rally. It was the combination of a lot of puts in the market that ended up being closed. A lot of them lost a lot of their effect on the markets, or a lot of their delta on the markets, and when all that gamma started being released from the markets, we actually ended up rallying. That is a cause of what happens when market makers actually sell people a lot of puts. If everyone's buying a bunch of puts as the market is crashing, when those puts start getting closed out, or when those puts start losing their delta because of time decay as well as the decrease in implied volatility, the market will tend to go in the opposite direction, which would be up. The same thing can happen to the upside. So in other words, if everyone's buying calls as we're going into these monthly expirations, if these calls are losing value because they're being closed, or time is passing by and their deltas are being decreased as those calls are being sold. So in other words, if the market is down here and everyone starts buying the 410 calls, and everyone's buying the 420 calls, and everyone's buying the 430 calls, market makers will be forced to buy shares to offset their delta. So if market makers are buying shares as everyone is buying those calls, that's going to help drive price up higher. Now, as price gets to these levels, if everyone starts closing out their calls, or let's just say those calls start losing value, so in this case we're talking about the 430 strike, as this was the strike that ended up being the absolute gamma strike. This is also the strike that everyone was piling into, as we were able to see in the gamma exposure. as well as even if you're not using gamma exposure, you could have looked at your options chain and you would have been able to see that there was a lot of open interest at the 430 strike. Now, if there's a lot of open interest in the strike, it could be interpreted as a lot of people are actually buying those calls, and that would be fueling the market makers to be buying a lot of shares. Now, as we're getting close to this expiration in which there was a lot of the 430 strike, if the 430 is not in the money, it's going to cause the market makers to sell the shares in which they purchased as a hedge to people buying the 430 strike. If that's a little bit confusing or a little bit unclear, don't worry about it. I will be doing a simplified video for that. But for those of you that have some sort of an understanding for this already, I just want to glance over it. I just want to glance over this, as I'm hoping to this video is not 30 minutes long. There's just a few other things I want to get to. So just know that's in a sense what we had here. So on top of that, from a technical standpoint, this was the 200-day moving average. I do believe I did mention that in this video right here. I talked about at this standpoint right here. Let me just mute this so it's not being discussed. So I was just talking about if we got over the 420 level. You guys can go back and check out the video here at 1050. I was talking about 417 at the top of this level here, but if we got past 417 and the market was able to get over 420, we would probably rally at that point, though, knowing that the 200-day moving average would probably come down to 430. At 430 is where the market would likely pull back to the 420 level. So I was just talking about the reasoning behind that, as well as why I was able to see that from the gamma exposure page. Now we can see that this was at that point in time the highest call open interest, and we can see that the 430 strike was growing. It was not as dominant as it ended up becoming. That caught me off guard, as I did not think it was actually going to become as dominant as it did. So I was actually in a little bit of trouble for the first week and a half of the month. As we broke out from here, this put me in a little bit of trouble here, as again, I was targeting 400 level. I had to just do some readjustments, so I'm now targeting the 410 level, and then for the shorter term trades I targeted 420. So these worked out really well. So it definitely helps when you have a lot of conviction, or you have a lot of reasons behind why you're holding your trades. Now, I'm not so much of a short-term trader. A lot of my spreads are sometimes 2, 3, sometimes even a month and a half out, so it gives me plenty of time to come in and adjust. So if the market is going against me for 1 week, it doesn't mean it's the end of the world. I just know that I have to stick firm with my thesis as I manage the risk before I actually open up the trade, so I was aware of what I was risking relative to what I was looking to gain. So in this case here, let's dial it down and we go to a smaller time frame right here. So this is just our 15-minute time frame. We can see that this is when the market hits the this is 430. Now 430 on the SPY is actually 430.10 on the ES, so you just have to add a 0 to the end of whatever price you're looking at the SPY, and then you just add 10. If you didn't know that, that will give you an approximation of where the SPX will be at whenever the SPY is at a certain strike price. At the same place, if you're targeting 420 on the SPY, that means for the ES, that's going to be 420.10. It's just off by 10 points, and you just obviously have to add the extra decimal because the SPX is 10 times larger than the SPY, and this goes to the same thing if you're trading the futures, which is the ES. Now, weeks like this tend to be amazing weeks. There's a lot of opportunity to make money because we're coming into, again, what was mentioned before, the monthly expiration, which is signified right here. So if the market is past where it should be, logically, that means you can just take the trade in the reverse direction here, which would have been targeting 420. The levels that were key to us was 425, because as the market broke past the 425 strike and the 430 strike started gaining a lot of interest as it started becoming the highest positive gamma exposure strike. The 425 strike was acting as the highest negative gamma strike, and it started actually becoming the second highest absolute gamma strike. To show you guys what I'm talking about here, let's take a look at the Quant Trading App Discord, in which I believe I pointed some of this out here. So this was something that I mentioned in the previous video, why this OPEX was significant. We can see how much premium was in it, and then we can see that there is the next highest expiration would be the quarterlies, which would be September 16th. Now September is going to be a big month because the FOMC announcement, the next one is during September towards the end of the month, and that's something we did not have this month, as well as the usual CPI numbers and other economic catalysts are going to be coming around here. On top of that, volatility tends to increase in September and October, and we're also experiencing a midterm election year, so those major things tend to increase implied volatility during the months of September and October. Now, as we scroll down here, this is where I was just showing the change in trend during the OPEXs, and then we have right here. So let's take a look. So this is, let's see here, what was I talking about here? So we have the, jump to it right here. we have at this point, I was just signifying that the highest negative gamma strike was 425. However, I believe I was talking about this time, what did I say here? So 430 is still pretty dominant and 425 is support. I would expect price to bounce back up. So this is just in reference to this day right here, in which the market did gap down and we did hit 425, but I was expecting the markets to rally back up, or to at least make another attempt back up to the 430 area. The reason for that being is because the 425 strike, even though it was growing in its negative gamma, which makes sense because the market did start selling off, the 430 strike was still acting as a very dominant strike right here. So let's take a look if I can have an example. So here we go. So we can see that the 430 strike was still pretty dominant as the market was selling off. Now we think of absolute gamma as sort of magnets for price. However, if we're dealing with a strike that is something like the 430 and price is hovering right below it and it's coming into a large OPEX, we can actually expect that price to act as some sort of a repellent and not necessarily a magnet. And that's in a case what started happening here. Now, everything you have to take with a grain of salt in the market, because this is just one way to analyze the market. Gamma exposure is not the entire reason behind why everything is happening in the market. At the end of the day, it comes down to supply and demand. If supply is exceeding demands, then price is going to fall. If demand is exceeding supply, then price is going to rise. In other words, if everyone's interested in buying something, it doesn't really matter what the gamma exposure is. It doesn't really matter what the market makers are going to have to do. They have to do what they have to do no matter what. It doesn't really matter what the news is saying, X, Y, Z. None of that matters. At the end of the day, if a lot of people are interested in buying something, the price is going to rise until it meets a point in which people are not that interested in buying anymore, and that's an area in which we would expect there to be some sort of supply, and then price would drop. So I just want to make sure that's clear. If you're now learning about gamma exposure, which is GEX, and you're starting to learn a little bit more of the advanced ways to analyze the market, you can't say that something's happening exclusively because of one reason. There's so many components and there's so many facets to the market. This is just another way to analyze it. I like to think of this as having some sort of X-ray vision when you look at the market. In other words, if you're looking at the chart and we know 430 is a level of resistance because the 200-day moving average is going to be here, or you have some sort of trend line or something in the area, you can then go take a look at the gamma exposure, and this is telling you exactly how strong that level might be. Now, if you compound that with some sort of confluence around time in terms of knowing when the next quarterly or monthly OPEX is, and then you compound that with maybe some sort of catalyst, and you start layering these things, that's where you start building larger trade ideas. And the more confirmations you have, or the more confluences you have, the more conviction you have behind your trade ideas. So in other words, even though the market was rallying against me during this whole time here, I was not as nervous knowing that I had conviction, and I already did my analysis 2 weeks ago when August started. So in other words, just because price was going against me short term or temporarily, it didn't necessarily allow me to lose my conviction, if you will. If anything, I just had to be more conservative with my price target instead of targeting 400, which now I think is way too far to target the end of the month. I was just targeting 420 or the 420 area for this expiration. And now for the rest of the month, I'll show you guys some of the spreads in which I'm currently in, or some of the targets in which I have. But from a day trade standpoint, this was a beautiful entry to get short here. If we take a look at the charts page right here, I just jumped back to this right here is the 16th. So this was the Tuesday, and this was as the market was rallying. I ended up entering some 425 puts, targeting the September expirations, just targeting September because I knew I was going to swing the trade. And at that point, the theta was a 0.09. And I believe I got filled around $7 on those contracts. So $7 on those contracts with a theta of 9 just means if I held it overnight, the theta was only going to cost me $9. I like trading contracts to expire 30 days out, or at least 21 days till expiration, just because of theta. And 425 was my first initial target, and that's what ended up happening here. So I don't necessarily need to show you guys every trade in which I took, but it was mentioned within the Quant Trading App Discord here. The following morning, I just closed the trade as soon as the market opened because we gapped down, and I didn't want to hold for 425 because that's where I was mentioning that I do believe that the market was going to bounce, and we did ended up bouncing that day here. I didn't want to hold naked puts and experience this, even though it just came down to a risk reward standpoint. If you think about it from a risk reward, if you swing puts from a level all the way up here and you get this big move, and now my target is 425, I'm risking too much because now I only stand to gain this much more profit However, if the market goes against me because there are naked puts, all the market has to do is just come back up to maybe this level, and then I'll be red on the trade, even though I might have entered it all the way up here. And it's just a psychological state in which I don't like being in. So if I know I got such a huge win, I'd rather just take the profit here at the open, and that's what I ended up doing, and then look for another entry later in the day. Now, aside from the naked options, this is where I run a lot of spreads here. So I just want to show you guys some spreads in which I am currently holding. So I do have this one right here. This is 44 days till expiration. The risk reward on something like this is amazing. So as you guys can see, it's already up $1.95 or $195 per lot. If I were to pull this down here and we say I was looking to hold this until the upcoming Friday here, so another 7 days, you guys can see if I was using 430 as my potential stop loss on this trade for the upcoming week here, it's still going to be profitable even all the way up to this strike price here. Now, it depends obviously on implied volatility. When I open it, the implied volatility was 21%. It's still about 21%, and this is option strat right here. So when I'm basing my implied volatility, I'm using it based on what option strat says, but I'm also aware of what it looks like on Thinkorswim. So if we look at this right here from a risk reward standpoint, if I don't have much concern that the market is going to be over 4,300, even if I was using this as my stop loss all the way up here, I'm risking about $225 or so, $250. If implied volatility was to decrease and we actually came all the way up here, which was what would likely to happen if the market was to come all the way up here, but let's just leave it at the way it is. You guys can see, so risking about 200 something bucks to, if the market just stays around this area, we're talking about 360 bucks, and if we were to pull all the way down to around here, 400 and change. Now that's for this week. If I was to continue to hold all the way until the 1st of September, or let's just say the first Friday of September, you guys can see how the risk reward starts becoming even better. If I'm using 4,300 as the level to risk off of and giving it a little bit of wiggle room for a few points above, it's still green. And if we're talking about all the way down here, we're talking about a wide enough range that makes it very comfortable to hold the trade. So in terms of, if you're in a couple of these right here and you're allocating this capital for 44 days till expiration, you have a comfortable range, it ends up becoming a really good risk rewards. It ends up becoming a really good risk reward, and I'm not really necessarily focused on what's happening every single tick during the day. Now, if we take a look at some other spreads, this is one that was opened right here at the on August 11th. So this was in a little bit of an adjustment as the market was rallying, decided to now target the 4,100 level instead of the 4,000 level. And this, a trade like this, I like to put about 1,500 bucks or so in terms of the cost of the trade. And if we were to pull this one now, so you guys can see, even though the market rallied a lot, the level in which I was expecting us to stall out around would be in this vicinity. So now, even though the market has rallied past the 10th, you guys can see this trade, I'm actually still up about 18%. Now, what I stand to gain versus what I stand to lose is now becoming exponentially greater, and that's just taking advantage of what's called the options convexity. When you enter in spreads like this, it means to the upside, it's a lot less risk versus what I stand to gain if I am right. Now, if I'm targeting the end of the month here, so this would be this Friday, if the market was back over 4,300, you guys can see I'd be down about 100 bucks. Now for a $1,500, $1,400 trade, that's not really a lot, right? So if we were to take a look at it from a standpoint of percentages, down about 8%, 9% or so, versus if the market was to pull back to this vicinity here, 180%. That's the way in which I approach my trading. I like to think of things in risk reward, but not for the intraday time frame. It's about supporting the larger trade thesis that I have and making sure that the risk is manageable for myself. So again, I'm not really concerned with this level here. It's just, this is where I think the market could potentially pull back to, but now I think it's too far. So I want to adjust myself and kind of target in this vicinity, because in the previous video, I do believe that I mentioned I thought the market would be around the 410 and the 400 level. With us being all the way up here, I just had to make a little bit of an adjustment. Now, if the market was to rally and if the market was to actually start selling off, all of these spreads in which I'm in, I'm going to be up a lot more. As you guys can see, a lot of them are already doing well off. Not all of these trades I am still in. Most of these are already closed out for profit. I just like to leave them on option strat to continue to track them to see how they would have done if I had to continue to hold, so I can take note of, so in the future I can know if I should hold the trade a little bit longer, what happened the last time, as I will just take these screenshots and save them in my notes. Jumping back to the Quant Trading App Discord here, I just want to show you guys, here's an example of what I'm talking about here. So this was the original one, which was the 4,100 butterfly that I would have opened up. When was this open up? So on August August 11th also, but now that the market is so far past this level, I was able to close this out for a break even here today, and then just jumped in another one that's a little bit closer to the money. So now this one has a much better chance of actually being profitable. If we were to pull this spread, that would be this one right here. 12 days till expiration, so not that long. It's already up 4%. That was open up earlier, but just showing you guys when I'm assessing the risk profile here. Let's just say I want to close this one out on this upcoming Wednesday. You guys see I want to be in a spread that has some sort of positive theta here, so I can continue to hold this versus the other one in which I was in. The theta, I believe, was only 1 or negative 1, which means if the market decides to consolidate next week, because it's so far out the money, as I was targeting the 4,000 level that's too far away, this one targeting 4150 is now very realistic, as that's well within a 1 standard deviation move for the SPX. So if I was to continue to hold this, let's just say up until the upcoming Friday, you guys can see that the risk reward is really good on a trade like this, and I'm layering different spreads on top of each other, but just managing the risk from the information or from the analysis that I do. So let's just wrap up this video by taking a look at the gamma exposure now. So this would be our gamma exposure at the market close, and you guys can see that a lot of gamma was just removed from the market, which means a lot of delta was removed from the market. More importantly, a lot of call delta was removed just because the market had rallied so much. As we talked about, the call premium was significantly greater than the put premium. So let's just run this report now by turning off today's expiration and take a look at what we see on the gamma profile. Okay, what we have is, let's scroll down, we can see that the dominant strike is 420, so that's the absolute GEX. Right now we have highest positive gamma still at 430, but it doesn't seem to be a lot of open interest growing above it. We do have 440, which is growing, but we'll take a look in a second exactly if that's for the leaps or if that's for the month of August or the September monthlies in a second. When it comes to the highest negative gamma strike, we see that we have 400 down here with a lot of puts still sitting down at that level. And if we take a look, the transition level, or the level in which the gamma will flip from negative to positive, it will happen right in this vicinity here. So 427 is a key level to have in mind. If the market was to continue to sell off and the 420 does not hold, we have a key level down at 410, which puts this in play, which is why I'm targeting 410 for my calendars for the end of the month, as well as the first week of September. Again, if the market goes against me in the upcoming week, I will just adjust those, roll them, push them up a little bit, not experiencing much drawdown, and probably add some sort of call calendars to take advantage of the price action that could happen all the way up here. Now let's also narrow it down a little bit. And this is the gamma exposure profile for the August expirations and then the September monthly. And you guys can see we end up closing at 422 here. This was the spot price when this page was generated. And let's scroll down and see nothing of significant. Actually, before we even take a look at that, we might as well remove this one, because now this expiration obviously was very dominant, but it expired. So let's see what we get when we run. This report. Actually, no, I'm going to leave this one here, and let's just jump to this, because I do believe, yeah, here we go. So I actually generated this report right before I started recording the video, just so I can have this already up. So as I'm scrolling to find the current spot price, here is the profile that we would want to use. Now, Monday morning pre-markets, some of this information is going to be different, because over the weekend, obviously the open interest levels will update depending on what new positions people open or close. So this will be very likely to change. However, it is cool to take a look at beforehand, and then Monday pre-market, I will form some sort of analysis for the rest of the month, deciding what positions I want to open. I like to think of positions in a 2-week cycle. So at the start of the month, then 2 weeks later, then in the middle of the month, I'll make a readjustment for the end of the month, and so forth. I'm not necessarily looking for trades every second of the day. When we look at this gamma exposure profile, we can see that what's important here is we still have a lot of call premium still overweighing the put premium, which is one way to think of this. Is the market is still, looking to balance out. Now it can balance out through passage of time. So if it wishes to consolidate for a little bit longer, or if it pulled back. If we take a look at this, another thing to take note of is now the net GEX is now negative for the next 27 days. So that's something that's going to say that we'll have increased volatility. If the market was to get back over 425, we'd likely enter some sort of positive gamma state. So that's where we'll have reduced volatility. So below 425, we can expect wider ranges in the market. On top of that, we can see that a lot of the notional delta has now become negative. This was not the case in which we were looking at. I believe even if we took a look at this video here, yeah, you guys can see that there was a lot more positive, a lot more green, and this was all green as the market has rallied. The reason that's happened, The reason that would be happening is because some people are closing out some of their calls, more puts are being added, and so forth, as well as the fact that the market has now started pulling back. We have the absolute gamma strike at 420, which dethrones the 430 strike, and then so this is highest positive gamma strike, this is the highest negative gamma strike, and this is absolute gamma. If we were to scroll down here, let's take a look. So again, the 427 level in the short term would be a key level right here. Market gets over it, reduce volatility at this level. We still have key resistance at 430. In this vicinity here, we can expect a decent amount of choppiness. If the 420 level was to not be held, we can expect a lot of volatility, and 410 would be very easily in play, unless of course, we start seeing some sort of support growing at the 415 level. If we look at this from a absolute gamma perspective, we can see right here 420 dominating makes sense. Spot price is pretty close to 420. Spot price is just the last traded price. It's the easiest way to think of it. We can see a balanced amount of absolute gamma between 425 and 415. So we can expect 420 right now to be pretty dominant. For traders, running iron condors is amazing, or very tight iron condors. There's all sorts of ways to take advantage of this. A couple traders in QTA were mentioning different spreads here. So if we were to take a look, here's an example of different ways to trade this. This is an iron condor using this information here, just looking to swing over the weekend. If we were to continue, this is using that information for a 0-day spread. I'm glad to see some of these traders coming up with some of these ideas on their own, as it's not just about me sharing trade ideas all day long. I'm just trying to show you guys the information, how to use this, how to analyze, how to take a look, and then kind of use the analysis to come up with your own trade idea. Here was a great win we had on Meta earlier this week here, as well as a few other trades. Now this was a great week for myself trading, just based on a lot of the information that I did in the video on August 1st. I tend not to change my plan for the most part as the month is progressing, because you want to understand that price is something that's just going to sometimes psych you out a lot of the time. And if you're managing your risks, you can trade in any environment, because at the end of the day, it's about risk management. You want to have some sort of thesis, something you want to stand by. So in other words, my conviction and my thesis for the month is still standing true. I'm just managing the risk accordingly, making the adjustments as the month goes along, making sure not to put too much risk on any particular trade, having the key levels. Once the market was below 425, it gave room for the markets to sell all the way off. This in a sense gave the conviction to the bears, because the level to clear was 425. Lastly, if there's anything else I guess I can share for the YouTube community, if you guys are not within Quant Trading App, different ways you can help use this information here. So here's some of the information in which I was talking about. This screenshot was taken pre-markets, so just signifying again how tight the 430 and 425 levels was. But now that the market was below 425, it was putting 420 significantly in play. As you can see, there was a lot of put open interest. This was also a high open interest strike collectively across these expirations, including the September expiration. So that gave a little bit of confidence for bears, short-term put traders, to trade the 420 put or run some sort of 420 butterfly, put butterflies. And then 427, again signifying that this is the level in which we would experience some sort of gamma flip. So it's going to end up being a key level here. For people that like to trade non-directionally, this is an example of the trade in which I opened last week Friday, expecting the markets to stay within this range for this week, or at least by Friday. That's why trades like this end up being amazing. You run a couple of these, it's about $3,000, a little under $3,000 in capital, and then from a Friday to Friday, you're pulling in close to $700. It ends up being painless, especially when you have a little bit of experience running short-term calendars. And I love these types of trades. So as the market closed, I just open up a couple of them here for the upcoming week. And then again, if market was to sell off here, I will just slap on another tent and then trade accordingly. I said I wasn't going to make this video 30 minutes. I just glanced over at the recording time and it looks like I'm pushing on the 30-minute mark. Sorry guys if these videos are too long. I will work on getting them smaller. I know some of you guys enjoy the longer videos, but I do want to mix it up and try to get videos around the 15 or under the 15-minute mark. If you enjoyed the video, like it, leave a comment down below if you learned anything. If you'd like to see more videos like this, some of my thought process, some of the current positions in which I'm in, how I'm navigating the markets, if you want to see a little bit more about the gamma exposure analysis, how I interpret it, how I'm looking at it, what trades I take, and so forth, let me know in the comments, and once I have the time, I will try to record more of these videos. Take care, guys. Thanks for watching. I'll catch you in the next one.